Question 1. The monitoring system demonstrates that a significant portion of consumers enrolled in a new health savings account (HSA) plan are not fully understanding the implications of their investment options and the tax advantages associated with their contributions. The compliance team is tasked with developing an updated communication plan to address this gap. Which of the following approaches is most likely to be effective and compliant with consumer protection regulations for CDHC plans? Option A. Distribute a comprehensive 50-page document detailing all investment fund prospectuses and IRS regulations pertaining to HSAs, with a mandatory acknowledgement of receipt required from all consumers. Option B. Develop a series of short, engaging video tutorials explaining the basics of HSA investment choices and tax benefits, supplemented by easily accessible FAQs on the plan website, and an option for consumers to schedule personalized phone consultations with a financial wellness advisor. Option C. Rely on the existing plan enrollment materials, which include links to the investment fund providers' websites, assuming consumers will independently seek out the necessary information. Option D. Create a simplified one-page infographic highlighting the most attractive potential returns of the HSA investment options, without delving into risk factors or detailed tax implications. Correct answer is B. Develop a series of short, engaging video tutorials explaining the basics of HSA investment choices and tax benefits, supplemented by easily accessible FAQs on the plan website, and an option for consumers to schedule personalized phone consultations with a financial wellness advisor. Explanation. This scenario presents a professional challenge because it requires balancing the need for clear, accessible communication with the regulatory obligation to provide accurate and comprehensive information regarding consumer-directed healthcare (CDHC) plans. The core ethical dilemma lies in determining how to simplify complex plan details without omitting crucial information that consumers need to make informed decisions, especially when dealing with diverse literacy levels and potential vulnerabilities within the consumer base. Careful judgment is required to ensure that the communication plan is both effective in engaging consumers and compliant with all applicable regulations. The correct approach involves developing a multifaceted communication plan that utilizes a variety of channels and formats to reach a broad audience. This approach prioritizes clarity, simplicity, and accessibility, while ensuring that all legally mandated disclosures are present and understandable. It recognizes that a one-size-fits-all communication strategy is insufficient for a diverse consumer population. By employing plain language, visual aids, and opportunities for personalized interaction, this strategy aims to empower consumers with the knowledge they need to manage their healthcare expenses effectively and make informed choices about their CDHC plans, thereby upholding the ethical duty of care and regulatory compliance. An incorrect approach that relies solely on providing lengthy, technical documents fails to meet the communication needs of many consumers. This approach is ethically problematic because it can lead to consumer confusion and disempowerment, potentially resulting in poor financial decisions or missed opportunities for optimal healthcare utilization. It also risks regulatory noncompliance if consumers cannot reasonably understand the terms and conditions of their plans. Another incorrect approach that focuses only on high-level summaries without providing access to detailed information is also ethically and regulatorily deficient. While aiming for simplicity, it omits critical details that consumers are legally entitled to know and may need for specific decision-making. This can lead to misunderstandings about coverage, costs, and responsibilities, creating a false sense of security or leading to unexpected financial burdens. A third incorrect approach that uses overly simplistic language and marketing jargon without any substantive information is ethically unacceptable. This approach borders on deceptive practices, as it may mislead consumers into believing they fully understand their plans when they do not. It fails to provide the necessary information for informed consent and decision-making, and it is highly likely to result in regulatory violations due to the lack of accurate and complete disclosures. The professional decision-making process for similar situations should involve a thorough understanding of the target audience's needs and literacy levels, a comprehensive review of all applicable regulatory requirements for disclosure and communication, and a commitment to developing communication materials that are both compliant and genuinely helpful to consumers. This involves iterative testing of communication materials with representative consumer groups and seeking feedback to ensure clarity and effectiveness. Professionals should prioritize transparency, accuracy, and accessibility in all communication efforts related to CDHC plans. Question 2. Governance review demonstrates that a consumer-directed healthcare (CDHC) plan administrator is evaluating its enrollment and onboarding processes. Which of the following approaches best ensures compliance with regulatory requirements and promotes informed member participation? Option A. Allowing self-attestation of eligibility for all CDHC plans without any subsequent verification or confirmation. Option B. Relying exclusively on an automated online enrollment system that requires minimal input from the prospective member, with a brief disclaimer at the end of the process. Option C. Implementing a comprehensive onboarding program that includes detailed plan documentation, personalized support through multiple communication channels, and a structured eligibility verification process. Option D. Providing only a high-level overview of plan benefits during onboarding, with minimal emphasis on specific rules regarding contributions, rollovers, and eligible expenses. The correct answer is C. Implementing a comprehensive onboarding program that includes detailed plan documentation, personalized support through multiple communication channels, and a structured eligibility verification process. Explanation. This scenario presents a professional challenge because the onboarding process for consumer-directed health care (CDHC) plans is a critical touchpoint that directly impacts member understanding, engagement, and compliance with regulatory requirements. Missteps during enrollment can lead to confusion, dissatisfaction, and potential regulatory violations, especially concerning the disclosure of plan features, eligibility, and contribution limits. Careful judgment is required to ensure that all prospective members receive accurate, comprehensive, and easily understandable information, empowering them to make informed decisions about their healthcare spending accounts. The correct approach involves a multifaceted onboarding strategy that prioritizes clear, accessible communication and robust verification. This includes providing detailed plan documents, offering personalized guidance through various channels, e.g., online portals, phone support, educational webinars, and implementing a structured verification process to confirm eligibility and understanding of key terms and conditions. This aligns with regulatory frameworks that mandate transparency, fairness, and the provision of adequate information to consumers to prevent deceptive practices and ensure informed consent. Ethical considerations also demand that individuals are not enrolled in plans they do not fully comprehend or are ineligible for. An incorrect approach that relies solely on automated online enrollment without adequate human support or supplementary educational materials fails to meet the standard of clear communication. This can lead to members misunderstanding their responsibilities, the limitations of their accounts, or the tax implications, potentially resulting in non-compliance or financial detriment. Such an approach risks violating regulations that require clear and conspicuous disclosure of material information. Another incorrect approach that involves providing only a brief summary of plan benefits without detailing contribution limits, rollover rules, or eligible expenses creates significant knowledge gaps. This omission can lead to members exceeding contribution limits, making ineligible purchases, or losing funds due to misunderstanding rollover provisions, all of which can have adverse regulatory and financial consequences. This approach neglects the fundamental ethical obligation to ensure members are fully informed about all aspects of their plan. A further incorrect approach that skips verification of eligibility and relies on self-attestation without any follow-up checks can lead to individuals enrolling in plans for which they do not qualify. This not only undermines the integrity of the CDHC program, but also exposes the plan administrator and the individual to potential penalties and disqualification of funds. This violates the principle of accurate record-keeping and adherence to program eligibility criteria mandated by regulations. The professional decision-making process for similar situations should involve a thorough understanding of the specific CDHC plan rules and the governing regulatory framework. Professionals must prioritize a member-centric approach, ensuring that the onboarding process is designed to educate and empower individuals, not just to process applications. This includes developing clear, concise, and accessible communication materials, offering multiple avenues for support and clarification, and establishing robust verification procedures to ensure compliance and member satisfaction. Regular review and updating of onboarding processes based on feedback and regulatory changes are also crucial. Question 3. The audit findings indicate that the FSA debit card system has a high rate of transactions being flagged for manual review due to a lack of immediate substantiation at the point of sale, leading to participant dissatisfaction and delays in reimbursements. Which of the following approaches best balances regulatory compliance with participant experience? Option A. Implement an automated substantiation system that uses merchant category codes and other data to pre-approve common eligible expenses, while requiring manual review and documentation for a targeted subset of transactions deemed higher risk. Option B. Discontinue the use of FSA debit cards entirely and require all participants to submit paper claims with original receipts for every expense. Option C. Rely solely on participant self-attestation for all debit card transactions, assuming all expenses are eligible unless a specific complaint is received. Option D. Automatically reject any debit card transaction that cannot be immediately verified as eligible at the point of sale, without offering a subsequent review process. Correct answer is A. Implement an automated substantiation system that uses merchant category codes and other data to pre-approve common eligible expenses, while requiring manual review and documentation for a targeted subset of transactions deemed higher risk. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how FSA debit card transactions are processed and reconciled against eligible expenses, directly impacting participant access to their funds and compliance with IRS regulations. The core of the challenge lies in ensuring that the debit card system effectively prevents improper reimbursements while maintaining a user-friendly experience for participants. Careful judgment is required to balance administrative efficiency with the strict requirements for substantiating FSA claims. The correct approach involves a robust system that automatically verifies eligible expenses at the point of sale or through subsequent review, ensuring that debit card transactions align with IRS guidelines for health savings accounts, HSA, and flexible spending accounts, FSA. This typically involves a combination of merchant category codes, substantiation requests for specific transactions, and clear communication with participants about what constitutes an eligible expense. This approach is correct because it directly addresses the regulatory requirement for substantiation of FSA expenses, preventing improper reimbursements, and ensuring compliance with IRS Publication 502 and other relevant guidance. It prioritizes accuracy and adherence to the law, which are paramount in managing consumer-directed health care accounts. An incorrect approach that relies solely on participant self-attestation without any automated verification or review mechanism fails to meet the regulatory obligation for substantiation. This creates a significant risk of improper reimbursements, as the administrator cannot confirm that the funds were used for eligible medical expenses. This approach is ethically problematic as it could lead to participants unknowingly violating IRS rules and facing tax penalties. Another incorrect approach that involves rejecting all debit card transactions that cannot be immediately substantiated at the point of sale, without providing a clear process for participants to submit supporting documentation later, is overly restrictive and creates an unacceptable burden on participants. While it errs on the side of caution regarding substantiation, it can lead to participants being unable to access their funds for legitimate expenses, causing financial hardship and undermining the purpose of the FSA. This approach fails to provide a reasonable and compliant process for substantiation. A third incorrect approach that involves a blanket policy of approving all debit card transactions without any form of review or substantiation process, regardless of the merchant or expense type, is a direct violation of IRS regulations. This approach completely disregards the requirement for verifying eligible expenses and opens the administrator and participant to significant compliance risks, including potential audits and penalties. The professional decision-making process for similar situations should involve a thorough understanding of the specific regulations governing FSAs and HSAs, particularly regarding debit card usage and substantiation requirements. Professionals should prioritize implementing systems and processes that automate verification where possible, establish clear and accessible procedures for participants to submit documentation, and maintain open communication channels to educate participants on eligible expenses. A risk-based approach to substantiation focusing on transactions that are more likely to be questionable, can also be employed. The ultimate goal is to create a system that is compliant, efficient, and supportive of participants' ability to utilize their healthcare funds appropriately. Question 4. The risk matrix shows a moderate likelihood of a consumer misunderstanding the tax implications and withdrawal restrictions of a health savings account, HSA. Which approach best aligns with the principles of healthcare consumerism and regulatory compliance for a financial advisor discussing HSA options with a new client? Option A. Emphasize the immediate tax deduction benefit of the HSA, highlighting it as a primary advantage for reducing current taxable income. Option B. Focus on the potential for HSA funds to grow over time through investment, presenting it as a supplementary retirement savings tool. Option C. Proactively educate the consumer on the tax advantages, withdrawal rules, long-term savings potential, and the importance of maintaining sufficient funds for qualified medical expenses. Option D. Briefly mention that HSA funds are tax-advantaged and can be used for medical expenses, without delving into specific withdrawal limitations or penalties. The correct answer is C. Proactively educate the consumer on the tax advantages, withdrawal rules, long-term savings potential, and the importance of maintaining sufficient funds for qualified medical expenses. Explanation. This scenario is professionally challenging because it requires balancing the promotion of consumer choice and engagement with the imperative to ensure consumers understand the financial implications and potential risks associated with their healthcare spending decisions. The core of consumer-directed healthcare, CDHC, is empowering individuals, but this empowerment must be grounded in informed decision-making. Misunderstanding the nuances of a health savings account, HSA, can lead to unintended tax consequences or a lack of adequate funds for future medical needs, undermining the very purpose of CDHC. The correct approach involves proactively educating the consumer about the tax advantages and withdrawal rules of an HSA, emphasizing the long-term savings aspect and the importance of maintaining sufficient funds for qualified medical expenses. This aligns with the principles of healthcare consumerism by ensuring the consumer has the necessary knowledge to make a truly informed choice about their healthcare finances. Regulatory frameworks governing HSAs, such as those established by the IRS in the United States, mandate that individuals understand the rules to benefit from tax-advantaged treatment. Ethical considerations also demand that financial products are presented with clarity, avoiding any implication of guaranteed returns or downplaying potential risks. An incorrect approach would be to simply highlight the tax deduction without explaining the limitations on withdrawals or the potential penalties for non-qualified distributions. This fails to provide a complete picture and could lead the consumer to believe the funds are as accessible as a regular savings account, which is not the case. This violates the principle of informed consent and could lead to financial hardship, a direct contravention of ethical practice. Another incorrect approach would be to focus solely on the immediate tax savings without discussing the long-term implications or the need for careful budgeting of HSA funds for future healthcare needs. This neglects the directed aspect of consumer-directed healthcare, where consumers are expected to manage their healthcare spending strategically. It also risks creating a false sense of security regarding future medical expenses. A third incorrect approach would be to present the HSA as a general investment vehicle, emphasizing potential growth without adequately stressing its primary purpose as a fund for qualified medical expenses. This misrepresents the nature of the account and could lead to misuse, resulting in tax penalties and a depletion of funds intended for healthcare. This is a failure to adhere to the specific regulatory intent of HSAs. Professionals should employ a decision-making process that prioritizes comprehensive consumer education. This involves 1. Assessing the consumer's current understanding of HSAs. 2. Clearly explaining the benefits and restrictions of the account. 3. Using plain language to avoid jargon. 4. Providing opportunities for questions. And 5. Ensuring the consumer can articulate their understanding of the account's purpose and rules before making a decision. This process ensures that the consumer's choice is truly informed and aligned with the principles of responsible healthcare consumerism. Question 5. Consider a scenario where an employer is seeking to implement a consumer-directed healthcare benefit to encourage employees to take a more active role in managing their healthcare expenses. The employer has a diverse workforce with varying income levels and health needs, and they are interested in offering a benefit that provides tax advantages and flexibility. Which of the following approaches best aligns with these objectives while adhering to the regulatory framework for CDHC in the United States? Option A. Creating a hybrid model that combines features of an HRA and an FSA, allowing for employer funding and employee contributions with a flexible spending window, without clearly defining the distinct regulatory implications of each component. Option B. Establishing a health reimbursement arrangement, HRA, where the employer fully funds reimbursements for a broad range of medical expenses, with no employee contribution requirement and no portability for unused funds. Option C. Implementing a health savings account, HSA program, allowing employees to contribute pre-tax dollars to a portable account that can be used for qualified medical expenses, provided they are enrolled in a high-deductible health plan, HDHP. Option D. Offering a flexible spending account, FSA, for healthcare expenses, where employees can elect to contribute pre-tax dollars, but with a strict use it or lose it rule for any remaining balance at the end of the plan year. The correct answer is C. Implementing a health savings account, HSA program, allowing employees to contribute pre-tax dollars to a portable account that can be used for qualified medical expenses, provided they are enrolled in a high-deductible health plan, HDHP. Explanation: this scenario presents a common challenge in administering consumer-directed health care, CDHC plans, optimizing the design and communication of different account types to best serve employee needs while adhering to regulatory requirements. The professional challenge lies in understanding the distinct features, limitations, and compliance nuances of health savings accounts, HSA, health reimbursement arrangements, HRA, and flexible spending accounts, FSA, to guide employers in selecting and implementing the most appropriate model or combination. Misunderstanding these differences can lead to non-compliance, employee dissatisfaction, and suboptimal utilization of benefits. The correct approach involves a thorough understanding of the regulatory framework governing each account type, specifically focusing on IRS guidelines for HSAs, HRA, and FSAs. This includes recognizing that HSAs are individual, portable accounts with specific eligibility requirements, e.g., enrollment in a high-deductible health plan and contribution limits, and that employer contributions are permissible. HRAs are employer-funded accounts with employer-defined rules for eligible expenses and reimbursement, and they are not portable. FSAs are employer-established accounts with a use-it-or-lose-it provision, though some carryover or grace period rules may apply, and they are also not portable. A professional would recommend a model that aligns with the employer's financial capacity, the workforce's health needs, and the desire for employee portability and control, while ensuring all IRS reporting and non-discrimination testing requirements are met. An incorrect approach would be to treat all three account types as interchangeable, or to implement a model without clearly delineating the unique rules and benefits of each. For instance, recommending an HRA without emphasizing its employer-defined nature and lack of portability would be a failure to accurately represent the product. Similarly, advising an employee to contribute to an HSA without confirming their eligibility for a high-deductible health plan would violate IRS rules. Another failure would be to suggest an FSA without adequately explaining the use-it-or-lose-it aspect, potentially leading to employee forfeiture of funds and dissatisfaction. These misrepresentations or omissions constitute regulatory and ethical failures, as they can lead to non-compliance with IRS regulations and a breach of fiduciary duty to provide accurate information. Professional decision-making in such situations requires a systematic process. First, assess the employer's objectives and financial constraints. Second, understand the workforce demographics and potential health care utilization patterns. Third, thoroughly review the specific IRS regulations and guidance for HSAs, HRA, and FSAs, including eligibility, contribution, and eligible expense rules. Fourth, present a clear, comparative analysis of each CDHC model, highlighting their respective advantages, disadvantages, and compliance considerations. And finally, recommend a solution that best balances employer goals with employee needs and regulatory adherence. Question 6. Governance review demonstrates that a company is exploring various methods to enhance employee access to health savings accounts, HSA. Which of the following funding source scenarios aligns with U.S. federal regulations governing HSAs? Option A. An employer proposes to contribute funds to employee HSAs to cover the premiums for a supplemental health insurance policy that is not an HDHP. Option B. An employer allows employees to contribute funds from their flexible spending accounts, FSA, directly into their HSAs to cover any remaining deductible amounts. Option C. An employer offers to match employee contributions to their HSA dollar for dollar up to the annual IRS limit, provided the employee is enrolled in a high-deductible health plan, HDHP. Option D. An employer suggests that employees take out personal loans to fund their HSA contributions, with the company providing a tax-free reimbursement for the loan interest. Correct answer is C. An employer offers to match employee contributions to their HSA dollar for dollar up to the annual IRS limit, provided the employee is enrolled in a high-deductible health plan, HDHP. Explanation: this scenario presents a professional challenge because it requires a nuanced understanding of the permissible funding sources for health savings accounts, HSA, under U.S. federal regulations, specifically the Internal Revenue Code, IRC, and related Treasury Department guidance. Misinterpreting these rules can lead to disqualification of the HSA, resulting in tax penalties for the account holder and potential compliance issues for employers. The core of the challenge lies in distinguishing between legitimate contributions and those that could be construed as impermissible, particularly when considering employer involvement. The correct approach involves recognizing that HSAs can be funded by employers, employees, or individuals. Employer contributions are generally permissible as long as they are made on a uniform basis to all eligible employees and do not exceed statutory limits. Employee contributions are typically made through payroll deductions, also subject to annual limits. Individual contributions are made directly by the account holder. The key regulatory principle is that contributions must originate from legitimate sources and not be used to circumvent the intent of HSA provisions, such as by being used to pay for health insurance premiums for non-qualifying coverage. An incorrect approach would be to assume that any contribution facilitated by an employer is automatically permissible without considering the nature of the contribution or the underlying health plan. For example, an employer offering to contribute to an employee's HSA to cover the cost of a short-term medical plan or a health insurance plan that is not a high-deductible health plan, HDHP, would be a regulatory failure. Such contributions would violate the spirit and letter of HSA regulations, which are tied to HDHP, and could be seen as an attempt to gain tax advantages for non-qualifying health expenses or coverage. Another incorrect approach would be to allow an employee to contribute funds that are derived from a source that is not permitted, such as a loan taken out specifically to fund the HSA, as this could be viewed as an indirect form of prohibited funding. Professionals should approach this by first confirming the definition of a qualifying HDHP and ensuring that any employer contributions are made in accordance with IRC Section 223 and related IRS guidance regarding uniformity and contribution limits. They must then verify that employee and individual contributions are made from their own funds and are not being used to pay for non-qualifying health insurance premiums or other prohibited expenses. A systematic review of all funding streams, coupled with a thorough understanding of the regulatory definitions of qualifying health coverage and permissible expenses, is crucial for maintaining HSA compliance. Question 7. System analysis indicates that a participant in a consumer-directed healthcare, CDHC, HRA has submitted a claim for reimbursement for a purchase described as wellness supplements. The submitted documentation includes a credit card statement showing the charge and a handwritten note from the participant stating the supplements were for general health. What is the most appropriate course of action for the HRA administrator to ensure compliance with substantiation requirements? Option A. Reimburse the participant based on their attestation and the credit card statement, assuming wellness supplements are generally considered a qualified medical expense. Option B. Request a detailed receipt from the vendor that specifies the exact nature of the wellness supplements and a letter from a healthcare provider confirming their medical necessity for the participant. Option C. Request a more detailed description of the supplements from the participant and a statement from their healthcare provider indicating how these supplements are intended to treat a specific medical condition. Option D. Deny the claim outright, as wellness supplements are not explicitly listed as a qualified medical expense in the HRA plan documents. Correct answer is B. Request a detailed receipt from the vendor that specifies the exact nature of the wellness supplements and a letter from a healthcare provider confirming their medical necessity for the participant. Explanation. This scenario is professionally challenging because it requires balancing the need for efficient reimbursement with the strict requirements for substantiating health reimbursement arrangement, HRA, expenses. Misinterpreting or overlooking these substantiation requirements can lead to improper reimbursements, potentially violating regulatory guidelines and eroding participant trust. Careful judgment is required to ensure that all reimbursements are compliant with the specific rules governing HRAs, which are designed to ensure that funds are used for qualified medical expenses. The correct approach involves a thorough review of the submitted documentation against the established HRA plan rules and relevant IRS regulations. This means verifying that the submitted receipts or explanation of benefits, EOB, clearly identify the service or product, the date of service, the provider, and the amount charged, and that these align with the definition of a qualified medical expense under the HRA plan and IRS guidelines. This meticulous process ensures that reimbursements are made only for eligible expenses, thereby maintaining compliance with the HRA's purpose and regulatory framework. An incorrect approach that relies solely on the participant's attestation without verifying the submitted documentation fails to meet the substantiation requirements. This can lead to reimbursements for non-qualified expenses, violating the principle of using HRA funds for medical care and potentially creating tax liabilities for the participant and the employer. Another incorrect approach, which involves accepting incomplete or illegible documentation, also bypasses the necessary verification steps. This opens the door to potential fraud or errors, as the eligibility of the expense cannot be confirmed. Furthermore, an approach that prioritizes speed over accuracy by approving reimbursements without a proper review of the submitted evidence directly contravenes the fiduciary responsibilities associated with administering HRA plans. Professionals should employ a decision-making framework that prioritizes compliance and accuracy. This involves establishing clear internal procedures for reviewing HRA claims, training staff on the specific substantiation requirements, and utilizing technology to flag incomplete or questionable submissions. When in doubt about the eligibility of an expense or the adequacy of documentation, it is prudent to request additional information from the participant or consult the HRA plan documents and relevant IRS guidance. The ultimate goal is to ensure that every reimbursement is both legitimate and compliant. Question 8. The risk matrix shows a moderate likelihood of a consumer misunderstanding the implications of high-deductible health plans, HDHP, when paired with a health savings account, HSA. Which of the following approaches best addresses this risk while adhering to consumer-directed healthcare, CDHC principles? Option A. Emphasize the significant tax deductions available for HSA contributions and the potential for tax-free growth and withdrawals for qualified medical expenses. Option B. Provide a detailed explanation of how HSAs work, including contribution limits, investment options, and the portability of funds, while clearly outlining the structure of the associated HDHP and the consumer's responsibility for out-of-pocket costs up to the deductible. Option C. Recommend the HSA option primarily because it offers the highest commission for the advisor. Option D. Present a simplified overview of HSAs and HDHP, focusing on the primary benefit of lower monthly premiums. Correct answer is B. Provide a detailed explanation of how HSAs work, including contribution limits, investment options, and the portability of funds, while clearly outlining the structure of the associated HDHP and the consumer's responsibility for out-of-pocket costs up to the deductible. Explanation. This scenario is professionally challenging because it requires an individual to navigate the complexities of consumer-driven healthcare, CDHC options, while ensuring compliance with specific regulatory frameworks designed to protect consumers and maintain market integrity. The core challenge lies in accurately assessing the suitability of different CDHC products for a consumer's unique needs and financial situation, without misrepresenting benefits or creating unrealistic expectations. Careful judgment is required to balance the promotion of consumer choice with the ethical obligation to provide clear, accurate, and unbiased information. The correct approach involves a thorough assessment of the consumer's health status, financial capacity, and risk tolerance, followed by a detailed explanation of the features, benefits, limitations, and costs of each relevant CDHC product. This approach aligns with the principles of informed consent and consumer protection embedded within CDHC regulations. Specifically, it adheres to guidelines that mandate clear disclosure of all terms, conditions, and potential risks associated with health savings accounts, HSA, health reimbursement arrangements, HRA, and flexible spending accounts, FSA, ensuring the consumer can make a truly consumer-directed decision based on complete understanding. An incorrect approach that focuses solely on the tax advantages of CDHC products fails to acknowledge the inherent risks and potential for unexpected out-of-pocket expenses. This oversight violates regulatory requirements for comprehensive disclosure and can lead to consumer detriment if the consumer is not adequately prepared for the financial responsibilities. Another incorrect approach that prioritizes the sale of the product with the highest commission, without a genuine assessment of the consumer's needs, represents a clear breach of fiduciary duty and ethical conduct, directly contravening regulations that emphasize consumer best interests. Finally, an approach that provides only a superficial overview of CDHC options, without delving into the specific operational details, eligibility criteria, and potential tax implications for each, leaves the consumer vulnerable to making an uninformed choice, which is a failure of the regulatory mandate for transparency and education. Professionals should employ a decision-making framework that begins with a comprehensive needs assessment of the consumer. This should be followed by a detailed, transparent, and unbiased presentation of all available CDHC options, including their respective advantages, disadvantages, costs, and regulatory implications. The process must empower the consumer to ask questions and ensure they fully comprehend the information before making a decision. This framework ensures that the consumer's well-being and informed choice are paramount, aligning with the spirit and letter of CDHC regulations. Question 9. Process analysis reveals that a consumer-directed healthcare CDHC plan administrator is tasked with evaluating the plan's performance over the past year. The administrator has access to data on total plan expenditures, the number of claims processed, and the average cost per claim. The administrator is considering different approaches to this evaluation. Which approach best reflects a comprehensive and compliant performance measurement strategy for a CDHC plan? Option A, focusing solely on the reduction of total plan expenditures and the decrease in the average cost per claim, as these are the primary indicators of financial efficiency. Option B, prioritizing the analysis of member satisfaction survey results to ensure members feel their needs are being met, regardless of the plan's financial performance or utilization patterns. Option C, examining the number of claims processed and the average cost per claim to identify areas where administrative efficiencies can be further improved. Option D, analyzing trends in member out-of-pocket expenses, member satisfaction survey results, and the proportion of preventive care services utilized, in addition to overall cost trends. The correct answer is D, analyzing trends in member out-of-pocket expenses, member satisfaction survey results, and the proportion of preventive care services utilized, in addition to overall cost trends. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how to evaluate the effectiveness of a consumer-directed healthcare (CDHC) plan beyond simple cost containment. The plan administrator must balance the financial viability of the plan with its ability to meet the healthcare needs of its members, ensuring that cost savings do not come at the expense of quality or access to care. This requires careful consideration of various performance metrics and a commitment to ethical stewardship of plan resources. The correct approach involves a comprehensive evaluation that considers both financial metrics and member outcomes. This includes analyzing trends in utilization, out-of-pocket expenses for members, and member satisfaction surveys, alongside traditional cost-saving indicators. This holistic view is crucial for demonstrating the plan's value and ensuring it aligns with the principles of consumer-directed care, which emphasize informed decision-making and access to appropriate services. Regulatory frameworks governing CDHC plans often mandate that such plans are not only cost-effective, but also promote member well-being and provide adequate coverage for essential healthcare services. A failure to consider member outcomes could lead to a plan that appears financially successful, but ultimately fails its members, potentially violating fiduciary duties and consumer protection guidelines. An incorrect approach would be to solely focus on reducing the plan's overall expenditure, without considering the impact on member access to care or the quality of services received. This could lead to members incurring higher out-of-pocket costs or being steered towards less effective, lower-cost treatments, which undermines the core purpose of a CDHC plan. Such a narrow focus might also overlook potential long-term cost increases due to delayed or inadequate care. Another incorrect approach would be to rely exclusively on member satisfaction surveys without correlating them with objective utilization and outcome data. While member satisfaction is important, it can be subjective and may not fully capture the effectiveness of the care received or the financial burden on members. A plan that prioritizes member satisfaction above all else, without a rigorous analysis of its financial performance and the actual healthcare outcomes, risks becoming unsustainable or failing to meet its fiduciary responsibilities. Professionals should adopt a decision-making framework that begins with clearly defining the objectives of the CDHC plan, which typically include promoting cost consciousness, empowering members, and ensuring access to quality care. This framework should then involve selecting a balanced set of performance metrics that capture financial efficiency, member utilization patterns, out-of-pocket costs, and member health outcomes. Regular review and analysis of these metrics, in conjunction with member feedback, are essential for making informed adjustments to the plan's design and administration. This iterative process ensures that the plan remains aligned with its objectives and regulatory requirements, fostering both financial sustainability and member well-being. Question 10. Market research demonstrates that consumer-directed health care plans are increasingly complex, with evolving regulatory requirements and a growing member base. A compliance officer is tasked with developing the annual audit plan to ensure adherence to all applicable laws and guidelines. Which of the following approaches would be most effective in managing compliance risks and optimizing audit resources? Option A. Allocate audit resources to examine every operational process within the CDHC program with the same level of scrutiny to ensure no detail is overlooked. Option B. Focus audits exclusively on areas identified in recent external regulatory examinations, without conducting independent internal risk assessments. Option C. Conduct audits on areas that have historically experienced minor, easily rectifiable compliance issues to maintain a consistent record of minor findings. Option D. Prioritize audit areas based on a comprehensive risk assessment that considers the likelihood of non-compliance and the potential impact on members and the organization. The correct answer is D. Prioritize audit areas based on a comprehensive risk assessment that considers the likelihood of non-compliance and the potential impact on members and the organization. Explanation. Scenario analysis. This scenario presents a common challenge in compliance audits within the consumer-directed healthcare (CDHC) sector. The core difficulty lies in balancing the need for thorough risk assessment with the practical constraints of audit resources and the dynamic nature of regulatory requirements. A compliance officer must identify potential areas of non-compliance that pose the greatest threat to the organization and its members, while also ensuring that the audit process itself is efficient and effective. The pressure to demonstrate value and identify actionable insights without overwhelming the organization with excessive scrutiny adds another layer of complexity. Correct approach analysis. The correct approach involves a risk-based methodology for compliance audits. This means prioritizing audit areas based on their likelihood of non-compliance and the potential impact of such non-compliance on the organization and its members. This aligns with the principles of effective risk management, which dictate that resources should be allocated to address the most significant threats. Regulatory frameworks for CDHC often emphasize proactive risk identification and mitigation. By focusing on areas with a higher probability of regulatory breaches and a greater potential for financial or reputational damage, the compliance officer ensures that the audit provides the most valuable insights and drives meaningful improvements. This approach is ethically sound, as it protects the interests of consumers and the integrity of the CDHC program. Incorrect approaches analysis. An approach that focuses solely on areas with a history of minor, easily correctable issues, without considering the potential for more significant, systemic problems, is flawed. This overlooks the possibility of emerging risks and fails to proactively address potentially more damaging compliance failures. It prioritizes convenience over effectiveness and may leave the organization vulnerable to substantial penalties or member harm. An approach that attempts to audit every single aspect of the CDHC program with equal intensity, regardless of inherent risk, is inefficient and unsustainable. This shotgun approach consumes excessive resources without a clear strategic focus, potentially leading to audit fatigue and a dilution of efforts on genuinely high-risk areas. It fails to acknowledge the practical limitations of audit teams and the need for targeted interventions. An approach that relies solely on external audit findings without internal risk assessment is also problematic. While external audits provide valuable perspectives, a robust compliance program requires continuous internal monitoring and risk identification. Ignoring internal risk signals, failing to integrate them into the audit plan, means missing opportunities for early intervention and potentially overlooking unique organizational risks that external auditors may not fully grasp. Professional reasoning. Professionals in CDHC compliance should adopt a systematic, risk-informed approach to audits. This involves 1. Understanding the regulatory landscape and identifying key compliance obligations. 2. Developing a risk assessment framework that considers the likelihood and impact of non-compliance across different operational areas. 3. Prioritizing audit activities based on this risk assessment, focusing on high-risk areas first. 4. Regularly reviewing and updating the risk assessment and audit plan to reflect changes in regulations, business operations, and emerging threats. 5. Ensuring that audit findings are actionable and lead to concrete remediation plans. Question 11. Risk assessment procedures indicate a potential for consumer misunderstanding regarding the application of deductibles, coinsurance, and co-payments within a new consumer-directed healthcare (CDHC) plan. Which of the following approaches best addresses this implementation challenge while adhering to regulatory requirements for consumer education and transparency? Option A. Develop comprehensive educational materials that clearly define deductibles, coinsurance, and co-payments, provide illustrative examples of their application to various services, and explain how they contribute to the out-of-pocket maximum. Option B. Emphasize the out-of-pocket maximum as the primary cost-sharing metric, with minimal explanation of the individual components that accrue towards it. Option C. Present the cost-sharing details exclusively in a technical appendix with extensive legal terminology, relying on the plan document itself for full disclosure. Option D. Provide a brief overview of the plan's cost-sharing percentages and dollar amounts in a single document, assuming consumers will seek further clarification if needed. The correct answer is A. Develop comprehensive educational materials that clearly define deductibles, coinsurance, and co-payments, provide illustrative examples of their application to various services, and explain how they contribute to the out-of-pocket maximum. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how cost-sharing mechanisms, specifically deductibles, coinsurance, and co-payments, are communicated to consumers within the Consumer-Directed Healthcare (CDHC) framework. The challenge lies in ensuring that the communication is not only accurate but also transparent and easily understandable, preventing potential consumer confusion or misinterpretation that could lead to unexpected financial burdens or dissatisfaction with their health plan. Careful judgment is required to balance regulatory compliance with the ethical imperative of consumer protection. The correct approach involves developing clear, concise, and easily accessible educational materials that define each cost-sharing mechanism, explain how they apply to covered services, and illustrate their impact on out-of-pocket expenses. This approach aligns with regulatory requirements that mandate clear disclosure of plan benefits and costs. Ethically, it upholds the principle of informed consent by empowering consumers to make well-informed decisions about their healthcare coverage. An incorrect approach would be to provide only a summary of the plan's cost-sharing structure without detailed explanations or examples. This fails to adequately inform consumers about the practical implications of deductibles, coinsurance, and co-payments, potentially leading to confusion and financial surprises. This approach violates the spirit of transparency and consumer education mandated by CDHC regulations. Another incorrect approach would be to present the cost-sharing information solely in technical jargon or within lengthy legal disclaimers. While technically compliant with some disclosure requirements, this method is not conducive to consumer understanding. It creates a barrier to comprehension, effectively obscuring the information rather than making it accessible, which is contrary to the goals of consumer-directed healthcare. A further incorrect approach would be to focus communication on the maximum out-of-pocket limit without adequately explaining how deductibles, coinsurance, and copayments contribute to reaching that limit. While the out-of-pocket maximum is a crucial piece of information, understanding the individual components that lead to it is essential for consumers to manage their healthcare spending effectively throughout the year. This incomplete communication can lead to a false sense of security or a misunderstanding of ongoing financial obligations. Professionals should adopt a decision-making framework that prioritizes consumer comprehension and empowerment. This involves 1. Identifying the target audience and their potential knowledge gaps. 2. Translating complex regulatory language into plain English. 3. Using multiple communication channels and formats, e.g., brochures, online tools, webinars. 4. Providing concrete examples of how cost-sharing applies to common services. And 5. Offering readily available support for consumer inquiries. The ultimate goal is to ensure that consumers can confidently navigate their CDHC plan and understand their financial responsibilities. Question 12. The efficiency study reveals that the current utilization management strategies within the Consumer-Directed Healthcare (CDHC) plan are not effectively controlling costs. The plan sponsor is considering several options to address this. Which of the following approaches best aligns with the regulatory framework for CDHC plans and ensures appropriate member care? Option A. Conduct a thorough review of all existing utilization management strategies to ensure they are evidence-based, consistently applied, and include clear appeal processes, while also assessing their impact on member access to medically necessary care. Option B. Immediately implement a blanket reduction in reimbursement rates for all elective procedures to curb spending, without a review of medical necessity. Option C. Introduce new, stringent pre-authorization requirements for a broad range of services based on a few provider complaints about overuse, without prior member notification. Option D. Focus solely on increasing member cost sharing for all services to incentivize reduced utilization, irrespective of medical necessity. The correct answer is A. Conduct a thorough review of all existing utilization management strategies to ensure they are evidence-based, consistently applied, and include clear appeal processes, while also assessing their impact on member access to medically necessary care. Explanation. This scenario presents a professional challenge because it requires balancing the need for cost containment within a consumer-directed healthcare (CDHC) plan with the ethical and regulatory obligations to ensure members receive medically necessary and appropriate care. The core tension lies in implementing utilization management strategies that are effective in controlling costs without unduly restricting access to care or creating barriers for members. Careful judgment is required to ensure that any implemented strategies are fair, transparent, and compliant with all applicable regulations, particularly those governing CDHC plans and health insurance. The correct approach involves a comprehensive review of the utilization management strategies to ensure they align with the principles of medical necessity and are applied consistently and fairly across all members. This approach prioritizes member well-being and adherence to regulatory frameworks that define appropriate utilization review processes. Specifically, it requires ensuring that all strategies are evidence-based, clearly communicated to members, and include robust appeal processes. This aligns with the regulatory intent of CDHC plans to empower consumers while ensuring that the underlying health plan structure provides for appropriate medical care, as governed by relevant U.S. federal and state insurance laws and regulations pertaining to health plan operations and consumer protections. An incorrect approach that focuses solely on reducing claims expenditure without a corresponding review of medical necessity would fail to meet regulatory requirements. Such an approach could lead to denials of care that are, in fact, medically necessary, thereby violating consumer protection laws and potentially the fiduciary duties of plan administrators. Another incorrect approach that involves implementing new pre-authorization requirements without adequate member notification or a clear rationale based on evidence-based medicine would also be problematic. This could create unexpected burdens for members and providers, potentially leading to delays in care and noncompliance with transparency and notice requirements mandated by health insurance regulations. A third incorrect approach that relies on anecdotal evidence or provider complaints to justify changes to utilization management without objective data, or a systematic review risks arbitrary decision-making and could be challenged as discriminatory or unfair, violating principles of equitable treatment and due process. The professional decision-making process for similar situations should involve a structured framework. First, identify the core objective, improving efficiency while maintaining quality of care and regulatory compliance. Second, gather comprehensive data on current utilization patterns and the impact of existing strategies. Third, research and evaluate potential new or revised utilization management strategies, assessing their potential impact on cost, quality, member access, and regulatory adherence. Fourth, consult relevant legal and compliance experts to ensure proposed strategies meet all jurisdictional requirements. Fifth, develop clear policies and procedures, including communication plans for members and providers. Finally, implement the chosen strategies with ongoing monitoring and evaluation to ensure effectiveness and compliance. Question 13. The monitoring system demonstrates that a significant portion of employees are not engaging with the company's voluntary wellness program, which offers resources on nutrition and stress management. The HR department is considering implementing a new initiative that requires all employees to participate in a weekly team-based fitness challenge, with individual progress tracked and shared with team leaders, and a portion of their annual bonus tied to meeting specific activity goals. Option A. Mandate participation in the weekly fitness challenge and require the sharing of individual progress logs with team leaders to ensure accountability and drive participation. Option B. Develop a communication campaign to re-emphasize the benefits of the existing voluntary program and offer additional, diverse wellness resources based on employee feedback, while ensuring all participation remains strictly voluntary. Option C. Offer substantial financial incentives for employees to undergo comprehensive health assessments and disclose detailed personal health data to the company to identify areas for targeted wellness interventions. Option D. Implement the new initiative, as it will increase engagement and promote a healthier workforce, which is a legitimate business interest. The correct answer is D. Implement the new initiative, as it will increase engagement and promote a healthier workforce, which is a legitimate business interest. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to promote employee health and reduce healthcare costs with the employee's right to privacy and autonomy regarding their personal health information. The employer has a legitimate interest in encouraging wellness, but the methods used must not be coercive or intrusive. Careful judgment is required to ensure that any wellness program aligns with ethical principles and relevant regulations governing health information and employment practices. The correct approach involves offering voluntary wellness programs that provide educational resources and incentives for participation without mandating specific health behaviors or requiring the disclosure of sensitive personal health information beyond what is necessary for program administration and aggregate reporting. This approach respects employee privacy, avoids potential discrimination, and fosters a culture of well-being through support rather than compulsion. It aligns with ethical principles of autonomy and non-maleficence, and regulatory frameworks that protect health information and prohibit discriminatory employment practices. An incorrect approach that mandates participation in a specific fitness challenge and requires employees to share daily activity logs with management is ethically problematic and likely violates privacy regulations. This approach is coercive, as it links participation to performance reviews and intrudes upon an employee's personal life and health choices. It also creates a risk of discrimination if employees are unable to participate due to health conditions or personal circumstances, and could lead to the misuse or inappropriate disclosure of sensitive health-related data. Another incorrect approach that involves offering significant financial incentives for employees to undergo specific biometric screenings and disclose detailed health results to the employer is also ethically flawed. While incentives are permissible, they must not be so substantial as to effectively coerce participation, especially when linked to employment benefits. Requiring the disclosure of detailed health results to the employer, beyond what is necessary for aggregate reporting or to determine eligibility for certain health-related benefits, and even then, with strict privacy safeguards, raises significant privacy concerns and could lead to discriminatory practices based on health status. The professional decision-making process for similar situations should involve a thorough review of applicable regulations, including those related to employee privacy, health information, and anti-discrimination laws. Employers should consult with legal counsel and HR professionals to design wellness programs that are voluntary, inclusive, and protect employee confidentiality. The focus should be on providing support and resources for healthy living, rather than on monitoring, mandating, or penalizing employees based on their health behaviors or outcomes. Transparency about program goals, data usage, and privacy protections is paramount. Question 14. The efficiency study reveals that while all three account types are designed to help individuals manage healthcare costs, their tax treatments and operational rules differ significantly. Considering the U.S. tax framework for consumer-directed health care accounts, which of the following statements most accurately distinguishes the tax advantages and characteristics of health savings accounts, HSA, health reimbursement arrangements, HRA, and flexible spending accounts, FSA? Option A. All three account types, HSA, HRA, and FSAs, share identical tax treatment, allowing for tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses, with no significant differences in their operational rules. Option B. Health savings accounts, HSA, and health reimbursement arrangements, HRA, both provide triple tax advantages and allow for individual ownership of funds, whereas flexible spending accounts, FSA, are limited to pre-tax contributions. Option C. Health reimbursement arrangements, HRA, offer the most significant tax advantages due to their employer-funded nature, allowing for unlimited tax-free contributions and withdrawals, while HSAs and FSAs have more restrictive tax benefits. Option D. Health savings accounts, HSA, offer triple tax advantages, tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses, and are individually owned, while health reimbursement arrangements, HRA, are employer-funded with tax-free reimbursements, and flexible spending accounts, FSA, allow pre-tax contributions and tax-free withdrawals, but typically have a use it or lose it provision and do not offer investment growth. The correct answer is D. Health savings accounts, HSA, offer triple tax advantages, tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses, and are individually owned, while health reimbursement arrangements, HRA, are employer-funded with tax-free reimbursements, and flexible spending accounts, FSA, allow pre-tax contributions and tax-free withdrawals but typically have a use it or lose it provision and do not offer investment growth. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the tax implications and regulatory distinctions between health savings accounts, HSA, health reimbursement arrangements, HRA, and flexible spending accounts, FSA, within the specific framework of U.S. tax law governing consumer-directed health care, CDHC. Misinterpreting these distinctions can lead to incorrect advice, potentially resulting in tax penalties for individuals and employers, and a failure to uphold fiduciary responsibilities. Careful judgment is required to accurately differentiate the tax treatment, eligibility, and contribution rules for each account type. The correct approach involves recognizing that HSAs are individual accounts owned by the employee that offer the most tax advantages, including tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. They are paired with high-deductible health plans, HDHP. This approach aligns with IRS regulations that permit these triple tax benefits for HSAs. An incorrect approach would be to suggest that HRAs offer the same triple tax advantage as HSAs. This is incorrect because while employer contributions to HRAs are tax-deductible for the employer and tax-free for the employee, and reimbursements for qualified medical expenses are tax-free, HRAs do not typically allow for individual ownership, investment growth, or employee contributions in the same manner as HSAs. Furthermore, HRAs are employer-funded, and the funds do not roll over indefinitely or become individually owned if the employee leaves the company, unlike HSAs. This fails to adhere to the specific IRS guidelines differentiating HSA and HRA tax structures. Another incorrect approach would be to equate the tax treatment of FSAs with HSAs. This is incorrect because while FSAs offer pre-tax contributions and tax-free withdrawals for qualified medical expenses. They generally do not allow for investment growth, and the use it or lose it rule, with limited exceptions for carryovers or grace periods, means that unused funds are forfeited at the end of the plan year. This fundamentally differs from the tax-advantaged growth and rollover features of HSAs. A further incorrect approach would be to state that all three account types, HSA, HRA, and FSAs, have identical tax treatment and eligibility requirements. This is incorrect as it ignores the distinct regulatory frameworks and tax benefits associated with each account type as defined by the IRS. HSAs are tied to HDHP and offer individual ownership and investment potential. HRAs are employer-funded with employer-defined rules, and FSAs are typically subject to annual limits and the use it or lose it provision. The professional decision-making process for similar situations should involve 1. Identifying the specific type of account being discussed, HSA, HRA, or FSA. 2. Recalling or researching the precise IRS regulations governing that specific account type, paying close attention to contribution limits, eligibility criteria, ownership, investment options, and withdrawal rules. 3. Comparing these specific regulations to the other account types to highlight their differences. 4. Providing advice that accurately reflects the unique tax treatment and operational characteristics of each account, ensuring compliance with all applicable U.S. federal tax laws. Question 15. Cost-benefit analysis shows that implementing a robust care coordination program can lead to significant long-term savings by reducing preventable hospitalizations and emergency room visits. When assessing the most effective care coordination strategy for a CDHC population, which approach best balances cost efficiency with regulatory compliance and patient-centered care? Option A. Focusing solely on administrative cost reductions within the care coordination department, without evaluating the impact on patient access to support services or the quality of care provided. Option B. Implementing the least expensive care coordination tools available, regardless of their proven effectiveness in addressing specific patient needs or potential for long-term cost savings. Option C. Prioritizing care coordination strategies that are directly informed by a comprehensive risk assessment of potential care gaps and their impact on patient outcomes and program costs. Option D. Adopting a standardized, generic care coordination protocol for all enrollees, assuming that a uniform approach will be universally effective and cost-efficient. The correct answer is C. Prioritizing care coordination strategies that are directly informed by a comprehensive risk assessment of potential care gaps and their impact on patient outcomes and program costs. Explanation: this scenario is professionally challenging because it requires balancing the financial implications of care coordination with the ethical and regulatory obligations to ensure patient well-being and access to appropriate care. Professionals must navigate the complexities of identifying effective strategies that are both cost-efficient and compliant with consumer-directed healthcare (CDHC) regulations, which often emphasize patient autonomy and informed decision-making. The risk assessment aspect is critical, as inadequate care coordination can lead to adverse health outcomes, increased healthcare costs due to preventable complications, and potential regulatory noncompliance. The correct approach involves a proactive risk assessment that identifies potential gaps in care coordination and evaluates the likelihood and impact of these gaps on patient health and program costs. This assessment should then inform the selection of care coordination strategies that directly address identified risks. For example, if the risk assessment reveals a high likelihood of medication non-adherence leading to hospital readmission, a strategy focusing on enhanced patient education and pharmacist involvement would be prioritized. This aligns with CDHC principles by empowering patients with information and support to manage their health effectively, while also mitigating financial risks associated with preventable adverse events. Regulatory frameworks for CDHC often mandate or encourage such proactive measures to ensure quality of care and responsible stewardship of healthcare funds. An incorrect approach would be to solely focus on cost reduction without a thorough risk assessment. This might lead to implementing strategies that appear cost-effective in the short term, but fail to address underlying care coordination issues, potentially increasing long-term costs through adverse events or patient dissatisfaction. For instance, reducing the number of care navigators without understanding the specific needs of the patient population could create significant gaps in support, leading to missed appointments or unmanaged chronic conditions. This would violate the spirit of CDHC by undermining patient ability to direct their own care, and could also contravene regulations that require adequate support services. Another incorrect approach would be to implement a one-size-fits-all care coordination strategy without tailoring it to the diverse needs of the CDHC population. This fails to acknowledge that different individuals will have varying levels of health literacy, access to resources, and specific health conditions. A strategy that does not account for these individual differences is unlikely to be effective and could lead to disparities in care, potentially resulting in negative health outcomes and increased costs for those who do not benefit from the standardized approach. This also undermines the directed aspect of CDHC, as it limits the ability of individuals to receive the specific support they need to manage their care. The professional decision-making process for similar situations should begin with a comprehensive understanding of the specific CDHC regulatory environment and its emphasis on patient empowerment and quality outcomes. This should be followed by a systematic risk assessment to identify potential vulnerabilities in care coordination. Based on this assessment, professionals should evaluate various care coordination strategies, considering their potential impact on patient health, cost-effectiveness, and regulatory compliance. The chosen strategies should be evidence-based, patient-centered, and adaptable to individual needs, with mechanisms for ongoing monitoring and evaluation to ensure their continued effectiveness and alignment with both patient goals and regulatory requirements. Question 16. The performance metrics show a growing interest in consumer-directed health care options among employees, prompting the HR department to explore implementing a health reimbursement arrangement, HRA. Which of the following best represents a balanced understanding of the advantages and disadvantages of an HRA for both employers and employees within the U.S. regulatory framework? Option A. An HRA is a government-mandated benefit designed to reduce employer healthcare spending by shifting all financial risk to employees, with no tax advantages for either party. Option B. An HRA is primarily a tool for employees to save for future medical expenses, with employers having minimal involvement beyond facilitating payroll deductions, and the funds are fully portable. Option C. An HRA allows employers to offer a tax-advantaged benefit that can help manage healthcare costs, while employees receive tax-free reimbursements for qualified medical expenses, but the funds are employer-specific and not portable. Option D. An HRA offers employers significant cost savings through tax deductions on contributions, and provides employees with portable funds that can be used for any healthcare expense, making it a universally beneficial option. The correct answer is D. An HRA offers employers significant cost savings through tax deductions on contributions, and provides employees with portable funds that can be used for any healthcare expense, making it a universally beneficial option. Explanation. This scenario is professionally challenging because it requires balancing the potential benefits of a health reimbursement arrangement, HRA, for both employers and employees against its inherent limitations and administrative complexities. Employers must consider the financial implications, administrative burden, and compliance requirements, while employees need to understand how the HRA impacts their healthcare spending, tax advantages, and overall financial well-being. Careful judgment is required to determine if an HRA is the most suitable consumer-directed health care option, given the specific organizational context and employee demographics, ensuring it aligns with the employer's goals and employee needs without creating undue administrative burdens or compliance risks. The correct approach involves a thorough evaluation of the HRA's advantages and disadvantages for both parties, considering the specific regulatory framework governing HRAs in the United States. This includes understanding that HRAs are employer-funded accounts that can reimburse employees for qualified medical expenses. For employers, advantages include potential cost containment, flexibility in plan design, and a way to offer a benefit that can be perceived as valuable by employees. Disadvantages for employers can include administrative costs, the need for careful record-keeping to ensure compliance with IRS regulations, e.g., non-discrimination rules, and the fact that unused funds generally revert to the employer. For employees, advantages include tax-free reimbursement for qualified medical expenses, a degree of control over healthcare spending, and the potential for a more personalized healthcare experience. Disadvantages for employees include the fact that HRAs are not portable, funds are tied to employment. The employer dictates the eligible expenses and contribution amounts, and employees must still manage their healthcare decisions and out-of-pocket costs. Comprehensive assessment would weigh these factors against other CDHC options like health savings accounts, HSA, or flexible spending accounts, FSA, considering factors like employer contribution levels, employee health needs, and administrative capacity. An incorrect approach would be to implement an HRA without fully understanding its limitations, such as assuming it offers the same portability as an HSA. This failure to recognize the employer-specific nature of HRAs can lead to employee dissatisfaction and confusion. Another incorrect approach would be to overlook the administrative and compliance requirements, such as failing to establish clear guidelines for eligible expenses or maintain proper documentation, which could lead to IRS penalties. Furthermore, promoting an HRA as a universal solution without considering the diverse financial and health needs of the employee population would be a flawed strategy, as it might not be the most beneficial or accessible option for all employees. Professionals should adopt a decision-making framework that begins with a clear understanding of the employer's objectives for offering a CDHC option. This should be followed by an assessment of the employee population's needs and preferences. A comparative analysis of different CDHC vehicles, HRA, HSA, FSA, should then be conducted, focusing on their respective advantages, disadvantages, administrative requirements, and compliance implications under U.S. federal law. The chosen approach should be clearly communicated to employees, outlining the benefits, limitations, and how to utilize the HRA effectively. Ongoing monitoring and evaluation of the HRA's performance and employee satisfaction are also crucial for process optimization. Question 17. The efficiency study reveals that a health plan is considering implementing a new wellness program designed to encourage members to engage in healthier lifestyles. The proposed program offers financial incentives for completing a health risk assessment and participating in a smoking cessation program. The plan is also exploring whether to tie a portion of the premium subsidy directly to the successful completion of these activities, which approach best aligns with the regulatory framework for consumer-directed health care, CDHC, regarding preventive care and wellness programs. Option A. Link the premium subsidy directly to achieving specific biometric targets, such as blood pressure and cholesterol levels, with no alternative pathways for those unable to meet these targets. Option B. Offer financial incentives for voluntary participation in a health risk assessment and a smoking cessation program, ensuring these activities are broadly accessible and do not penalize individuals for health status. Option C. Mandate participation in a comprehensive fitness challenge with specific weight loss targets to receive the full premium subsidy. Option D. Provide a significant financial penalty on premiums for individuals who do not complete a health risk assessment within a specified time frame. The correct answer is B. Offer financial incentives for voluntary participation in a health risk assessment and a smoking cessation program, ensuring these activities are broadly accessible and do not penalize individuals for health status. Explanation. This scenario is professionally challenging because it requires balancing the potential benefits of a wellness program with the regulatory obligations to ensure fair and equitable access to preventive care benefits under the Consumer-Directed Healthcare, CDHC framework. The core tension lies in designing a program that incentivizes healthy behaviors without creating discriminatory barriers or violating rules around benefit design. Careful judgment is required to ensure the program aligns with the spirit and letter of CDHC regulations, particularly concerning non-discrimination and the definition of preventive care. The correct approach involves designing a wellness program that is voluntary and offers rewards for participation in activities that are clearly defined as preventive care or health promotion, without imposing undue burdens or penalties on individuals who cannot participate due to health status or other protected characteristics. This aligns with regulatory guidance that emphasizes the voluntary nature of wellness programs and the need to ensure they do not discriminate. The focus on offering rewards for participation in activities that are broadly accessible and beneficial for health promotion, such as health risk assessments and smoking cessation programs, is a key indicator of compliance. An incorrect approach would be to implement a wellness program that links significant financial incentives or penalties directly to achieving specific health outcomes, e.g., weight loss, blood pressure targets. This can be problematic because it may inadvertently penalize individuals with pre-existing conditions or those for whom achieving such outcomes is medically difficult, potentially violating non-discrimination provisions. Another incorrect approach is to make participation in the wellness program mandatory for receiving certain preventive care benefits. This directly contravenes the voluntary nature of such programs and could be seen as a barrier to accessing essential preventive services. Finally, offering rewards for activities that are not clearly linked to preventive care or health promotion, or that are overly burdensome to access, could also be deemed non-compliant, as it may not genuinely promote wellness or could create an unfair advantage for some participants. Professional decision-making in similar situations requires a thorough understanding of the specific CDHC regulations governing wellness programs and preventive care. Professionals must first assess whether the proposed program design is voluntary and whether the incentives or penalties are reasonably related to participation in health-promoting activities. They should consider the potential impact on individuals with different health statuses and ensure that the program does not create a barrier to accessing essential preventive services. Consulting regulatory guidance and seeking legal counsel, when in doubt, is a critical step in ensuring compliance and ethical practice. Question 18. The performance metrics show a consistent increase in employee turnover among those who have expressed dissatisfaction with the current health benefit offerings. The employer, a small business with 35 full-time equivalent employees and no existing group health plan, is seeking a compliant and cost-effective way to provide health benefits and improve employee retention. They are exploring options to reimburse employees for health insurance premiums purchased on the individual market. Which of the following approaches best aligns with the regulatory framework for consumer-directed health care, CDHC, in this specific scenario? Option A. Offer an integrated HRA, as it provides flexibility in reimbursement amounts for qualified medical expenses. Option B. Implement a standalone HRA designed to reimburse for individual health insurance premiums. Option C. Establish a qualified small employer HRA, QSERA, with reimbursement limits set at the maximum allowed by IRS guidance. Option D. Propose an individual coverage HRA, ICHRA, with a broad design to cover all employees. The correct answer is C. Establish a qualified small employer HRA, QSERA, with reimbursement limits set at the maximum allowed by IRS guidance. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of different health reimbursement arrangement, HRA types, and their specific regulatory limitations, particularly concerning employer size and eligibility. The core of the challenge lies in correctly identifying which HRA structure can be offered to a specific group of employees, while adhering strictly to the Consumer-Directed Healthcare, CDHC, regulatory framework, which in the U.S. context is primarily governed by the Affordable Care Act, ACA, and IRS guidance. Misinterpreting these rules can lead to non-compliance, potentially invalidating the HRA, and creating tax liabilities for both the employer and employees. The correct approach involves recognizing that a qualified small employer HRA, QSERA, is designed for employers with fewer than 50 full-time equivalent employees who do not offer a group health plan. This approach is correct because it directly addresses the employer's size constraint and the desire to provide health benefits without establishing a traditional group plan. QSERA allow employers to reimburse employees for health insurance premiums and other qualified medical expenses up to statutory limits, offering a compliant and flexible solution for smaller businesses. This aligns with the ACA's intent to provide accessible health coverage options. An incorrect approach would be to suggest an integrated HRA without considering the employer's group health plan status. Integrated HRAs must be offered in conjunction with a group health plan, and if offered independently, they are considered taxable benefits and can lead to penalties under the ACA's employer shared responsibility provisions. Another incorrect approach would be to propose an individual coverage HRA, ICHRA, without verifying the employer's size and the specific design of the ICHRA. While ICHRA offer more design flexibility than QSERA, they have different eligibility and design requirements, and offering them inappropriately could violate ACA provisions. Finally, suggesting a standalone HRA without ensuring it meets the specific requirements for an accepted benefit HRA would be incorrect. Non-accepted benefit HRAs are generally not permitted under current regulations, as they can be used to reimburse for individual market insurance premiums, which is a function now largely reserved for QSERA and ICRA. The professional decision-making process for similar situations should begin with a thorough assessment of the employer's characteristics, size, existing benefit offerings, and overall strategic goals for employee compensation and health benefits. Next, a detailed review of the specific regulatory requirements for each HRA type, QSERA, ICRA, Integrated HRA, Standalone HRA as an accepted benefit, must be conducted. This involves consulting IRS guidance and relevant sections of the ACA. The chosen HRA structure must then be demonstrably compliant with all applicable rules, ensuring it meets the employer's needs without creating compliance risks. Question 19. The monitoring system demonstrates that a significant portion of employees enrolled in the Employer-Sponsored Health Savings Account (HSA) program are not maximizing their contributions and are also unclear about the range of eligible medical expenses. Which of the following employer strategies best aligns with best practices for promoting effective HSA utilization and regulatory compliance within the Consumer-Directed Healthcare (CDHC) framework? Option A. Automatically enroll all eligible employees into the HSA program with the default contribution set to the maximum allowable limit to ensure immediate tax benefits. Option B. Provide a single, brief informational flyer at the time of enrollment that outlines the basic definition of an HSA and directs employees to the IRS website for further details. Option C. Focus employer efforts on ensuring accurate and timely processing of contributions, assuming employees will independently seek out information on contribution limits and eligible expenses as needed. Option D. Implement a comprehensive educational campaign that includes webinars, detailed guides on eligible expenses, and personalized support sessions to help employees understand contribution limits, the benefits of long-term savings, and how to correctly identify qualified medical expenses. The correct answer is D. Implement a comprehensive educational campaign that includes webinars, detailed guides on eligible expenses, and personalized support sessions to help employees understand contribution limits, the benefits of long-term savings, and how to correctly identify qualified medical expenses. Explanation. This scenario presents a professional challenge because employers have a fiduciary responsibility to administer health savings accounts, HSA, in a manner that is compliant with IRS regulations and promotes employee financial well-being. Mismanagement can lead to penalties for the employer and financial detriment for employees. The core of the challenge lies in balancing administrative efficiency with the ethical and legal obligations to ensure employees understand and effectively utilize their HSAs. Careful judgment is required to implement processes that are both compliant and supportive of employee financial health. The correct approach involves proactive education and clear communication regarding HSA contribution limits, eligible expenses, and the long-term benefits of saving. This aligns with the regulatory framework by ensuring employees are empowered to make informed decisions, thereby maximizing the tax advantages and utility of their HSAs. It also reflects best practices by fostering a culture of financial literacy within the workplace, which is crucial for the success of consumer-directed healthcare. An incorrect approach that focuses solely on automated enrollment without providing educational resources fails to meet the spirit of consumer-directed healthcare. It places the burden of understanding complex rules entirely on the employee, potentially leading to underutilization or incorrect contributions, which is not in line with the intent of HSAs. This approach risks non-compliance if employees are not adequately informed about contribution limits, leading to excess contributions that incur penalties. Another incorrect approach that prioritizes minimal employer administrative burden by offering only basic information about HSA eligibility without detailing contribution limits or eligible expenses is also problematic. While technically providing some information, it falls short of best practices and may inadvertently lead employees to make costly errors. This lack of comprehensive guidance can be seen as a failure to adequately support employees in managing their healthcare finances, potentially exposing the employer to reputational risk and employee dissatisfaction. A further incorrect approach that involves encouraging employees to maximize contributions without clearly outlining the implications of such decisions, such as potential cash flow issues for the employee or the importance of understanding investment options for long-term growth, is also flawed. While seemingly beneficial, it lacks the necessary nuance and comprehensive guidance required for responsible HSA management. This can lead to employees making decisions that are not in their best long-term financial interest, undermining the purpose of HSAs as a tool for long-term health care savings. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant IRS regulations governing HSAs. This should be followed by an assessment of employee needs and potential knowledge gaps. The implementation of a robust educational program, coupled with clear and accessible communication channels, should be prioritized. Regular review and updates to educational materials and administrative processes are essential to ensure ongoing compliance and effectiveness. The ultimate goal is to empower employees to make informed decisions that optimize their HSA utilization and financial well-being. Question 20. The assessment process reveals a client expressing significant apprehension about enrolling in a health savings account, HSA, due to concerns about managing funds and potential future medical expenses. Which approach best promotes informed decision-making in this scenario? Option A. Begin by empathetically acknowledging the client's anxieties, then conduct a personalized risk assessment to understand their financial comfort level and anticipated healthcare needs, before explaining HSA concepts in simple terms and confirming their understanding. Option B. Schedule a follow-up meeting after the client has had time to review the HSA materials independently, focusing on clarifying any specific points of confusion they identify. Option C. Advise the client to consult with a financial advisor for all HSA-related decisions, as the complexity may be beyond the scope of their current understanding. Option D. Provide a comprehensive, detailed brochure outlining all HSA features, tax implications, and investment options. Then ask the client if they have any questions. The correct answer is D. Provide a comprehensive, detailed brochure outlining all HSA features, tax implications, and investment options. Then ask the client if they have any questions. Explanation. The assessment process reveals a client who is experiencing significant anxiety regarding their health insurance options, specifically concerning a health savings account, HSA. This scenario is professionally challenging because the client's emotional state could impair their ability to process complex information and make rational decisions about their healthcare finances. The core of the challenge lies in balancing the need to provide comprehensive information with the client's capacity to absorb and utilize it effectively, ensuring their choices are truly informed and aligned with their needs and risk tolerance. The correct approach involves a structured, empathetic, and iterative process of risk assessment and education. This begins with actively listening to the client's concerns to understand the root of their anxiety and their current level of understanding. It then moves to a clear, jargon-free explanation of HSA features, benefits, and risks, tailored to their expressed concerns. Crucially, this approach emphasizes empowering the client by providing them with the tools and information to weigh the pros and cons in relation to their personal financial situation and healthcare utilization patterns. This aligns with the regulatory framework's emphasis on promoting informed decision-making by ensuring individuals have a clear understanding of their choices and the potential consequences, thereby enabling them to act in their own best interest. Ethical considerations also mandate that professionals act with due diligence and avoid undue influence, ensuring the client's autonomy is respected. An incorrect approach would be to overwhelm the client with a deluge of technical details without first addressing their anxiety or assessing their comprehension level. This fails to promote informed decision-making because the client is unlikely to retain or understand the information presented, leading to decisions made under duress or based on incomplete understanding. This violates the spirit of consumer-directed healthcare, which is predicated on informed consumer choice. Another incorrect approach is to make a recommendation without fully exploring the client's individual circumstances, risk tolerance, and financial capacity. This bypasses the essential step of risk assessment and can lead to a recommendation that is not suitable for the client, potentially resulting in financial hardship or inadequate healthcare coverage. This is ethically problematic as it prioritizes expediency over the client's well-being and fails to uphold the professional duty of care. A further incorrect approach involves assuming the client understands all the implications of an HSA based on a brief overview. This lack of follow-up and confirmation of understanding means the client may proceed with decisions based on a false sense of comprehension. This is a failure in the duty to ensure informed consent and can lead to significant regret or negative outcomes for the client. The professional decision-making process for similar situation should involve a systematic approach. First, establish rapport and actively listen to understand the client's concerns and current knowledge base. Second, conduct a needs and risk assessment, considering their financial situation, anticipated healthcare needs, and comfort level with financial risk. Third, provide clear, concise, and tailored information about the available option, explaining both benefits and potential drawbacks. Fourth, check for understanding frequently and encourage questions. Fifth, empower the client to make the final decision by providing them with the necessary resources and support without coercion or undue influence.